Bitcoin kills gold. Bitcoin has now a lower inflation than there is annual production of gold. So Bitcoin is harder than gold. Now, what does this mean for gold? Let's have a look at Bitcoin versus gold. Because apparently people aren't very worried about the current dip. This is the realized loss by long-term and short-term holders. And during the prior bull run in 2021, we had massive loss realization once the bull market stopped. Currently, we don't see that. People are not yet worried. People keep on holding both long-term as well as short-term holders. And one reason for this might be the low inflation after the halving. With the halving, Bitcoin's inflation rate is at 0.8%, whereas gold's production is at 2.3% annualized. So that makes it the harder currency. At the same time, we can guesstimate on-chain that roughly 2% of all of Bitcoin supply get lost every year. So we actually have a shrinking supply of Bitcoin now. With gold, it's very hard to estimate how much is actually getting lost. And so have a look at the following chart. You've probably never seen this before. This is the gold price divided by the Bitcoin price. So how many Bitcoin does it take to buy one gold coin? And of course, Bitcoin appreciated a lot, but it's very nice to see on this curved line how there are actually aligning bottoms. So how much could gold relative to Bitcoin fall from here? Because we are not now at the bottom. The answer is roughly 50%. So either Bitcoin could double from here, or the gold price could get cut in half, or a mixture of both. That's of course in case we do see those lower levels again. Who knows if we go down or up from here. But it's simply a nice coincidence to see how 1, 2, 3, 4, 5, 6 data points are all along a curved line. Here's a chart you've probably also never seen. What we've got over here is the gold price divided by the S&P 500 long term. Now, why do I want to look at charts like this? Most people simply just look at US dollar charts, right? Because that's in the end how we spend our money. We want to know how many US dollars can we get per Bitcoin or per gold coin. But the issue is that there is an expanding fiat supply. And so of course, over time, as there is more fiat, the prices of everything is going up, right? The price of houses, of stocks, of gold, of Bitcoin, everything is going up. And so we get a distorted picture. However, once we divide the price of one investment with the price of another investment, now suddenly the fiat inflation doesn't matter that much anymore, right? Now we simply just look at relative performances. So the fiat supply can double or triple, then all of the prices, of course, double and triple. This does not make any difference on relative valuations. And so looking at this, at the gold price relative to the S&P 500 is very, very interesting. We are starting here in August of 1971. So this was Bretton Woods. This is when the US dollar was not anymore one-on-one convertible to the gold. So people sold their fiat in order to buy gold directly. So we saw a massive outperformance of gold relative to the S&P 500. Then we got our technology boom. So stocks outperformed a lot. Gold declined a lot, relatively speaking. Have a look at the scale, right? We will check the relative declines in a second. Then we saw gold again outperforming. This was when the dot-com bubble suddenly burst. And currently, we still see a slight underperformance versus the S&P 500. Now, what we see over here, this line is an 8-year moving average. So this could be one way to time the market, right? This could be one way to potentially be more invested in gold whenever there's positive momentum. Currently, it seems like we haven't yet broken the negative trend. At least again in relative valuation, right? Not in US dollars, of course, because everything is going up. So check this out. This is an outperformance versus the S&P 500 of 560% for gold. And have a look at this underperformance. That's minus 86%. So those kinds of movements really, really matter. Now, what do movements like this tell us? To me, this shows that once you go across asset classes, so not similar assets within an asset class, so not say different stocks or different cryptocurrencies, once you jump the asset class barrier and you look at stocks versus gold or at gold versus Bitcoin, etc., correlation collapses. As in one asset can go up and the other asset can go down. There isn't a lot of synchronous movements. And this is why people say it makes sense to diversify, right? Once you've got different asset classes, then the over fluctuations of your portfolio won't be that drastic anymore. But besides reducing volatility in a portfolio, this also helps helps us to potentially outperform, right? When we can somehow time the market a little bit, as in buy gold when it makes sense and sell gold when technology stocks tend to outperform. And we don't have to actively trade this every single day. We just have to sometimes every few years rebalance. Then we do have a potential additional source of alpha, another source of outperformance. We want to be buying gold when everybody is panicking and when the outperformance starts, and vice versa. We want to get risk on when everybody gets excited about technology again. The same, of course, can be said for crypto. The same can be sought for government bonds. Long-term government bonds, for example, are now very, very cheap because interest rates are high. So it might make sense to buy some. Fundamentally, though, I believe we can be safe that Bitcoin is here to stay because of the approval of the ETF, but also because now the supply net is shrinking. The circulating supply is shrinking because more Bitcoin gets lost than is being mined. So it does become a rarer asset compared to gold, for example. If it's your first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. If you've got Telegram, feel free to join us. Link is down below. Looking forward to chatting with you.